Between 1873 and 1907, the United States endured 5 major banking panics that wiped out entire fortunes in a matter of days. But a small group of frontier merchants, ranchers, and businessmen survived every single one. Not because they were lucky, but because they used a simple 3-account system that protected their wealth when everyone else's vanished. The Panic of 1873 started on September 18th when J. Cook and Company, one of the most powerful banking houses in America, declared bankruptcy. Within hours, the New York Stock Exchange suspended trading for the first time in its history. Depositors rushed to withdraw their money, and banks across the country slammed their doors shut. By September 20th, the panic had spread from New York to Chicago, Virginia City, and San Francisco. 25% of workers in New York became unemployed. More than 100 businesses failed between 1873 and 1875. Ordinary people who trusted a single bank with all their savings lost everything. Here's what happened. Banks during the 1870s operated on fractional reserve. They only kept a small percentage of deposits on hand and loaned out the rest. When panic hit and everyone rushed to withdraw at once, the banks simply didn't have the cash. Doors closed, deposits disappeared, and families lost their life savings overnight. But smart frontier businessmen saw this pattern early and built protection into their financial structure. They didn't trust a single bank with all their money. They spread it across 3 different accounts at 3 different types of institutions, each serving a specific purpose. Account 1 was their operating account, the money they needed for daily expenses, payroll, and immediate business operations. This stayed at their local bank because proximity mattered when you needed cash fast. But they never kept more than 30 days of operating capital in that account. Account 2 was their reserve account, held at a larger regional bank in a major city like San Francisco, Denver, or Kansas City. This account held 3 to 6 months of operating reserves and acted as their safety net if the local bank failed. Regional banks in major cities were less likely to collapse because they had more diversified loan portfolios and access to emergency liquidity from New York correspondent banks. Account 3 was their long-term savings, and this is where it gets interesting. They didn't keep this in a bank at all. They converted it into hard assets that couldn't vanish overnight: real estate, livestock, precious metals, or secured loans to trusted borrowers. Think about why this worked. When the Panic of 1873 hit Virginia City, local banks closed their doors and depositors lost everything. But the men using the 3-account system only had 30 days of operating capital at risk in that local bank. Their reserve account at the regional bank in San Francisco stayed intact because that institution had access to emergency funding from New York correspondent banks. And their long-term savings in Account 3, the real estate, the livestock, the hard assets, couldn't be touched by bank failures. Those assets held their value while paper money vanished. The pattern repeated in 1884. Banks failed across New York, and the panic spread west. The brokerage firm of Grant and Ward collapsed, taking down the Marine National Bank. Depositors who had everything in one institution lost it all. But the men running the 3-account system walked through the crisis with their wealth intact. Then came 1890 and another wave of bank failures. The brokerage firm Decker, Howell and Company collapsed, threatening the Bank of North America. Depositors panicked and began withdrawing substantial sums. The crisis spread to Philadelphia and Richmond before J.P. Morgan convinced 9 New York banks to extend emergency aid. By the time the Panic of 1893 hit, the worst of them all, frontier businessmen who'd adopted the 3-account system had survived 3 major crises without losing their life savings. From mid-July to mid-August 1893, 340 banks suspended operations. More than 100 banks in Chicago and Los Angeles shut their doors in June alone. But the 3-account system protected wealth that single bank depositors lost overnight. Here's the brutal lesson most people miss. The banking system today is more stable than it was in the 1870s, but it's not invincible. We saw bank failures as recently as 2023 when Silicon Valley Bank and First Republic collapsed. Depositors with balances over $250,000, the FDIC insurance limit, were at risk of losing everything above that threshold. The three-account system that frontier businessmen used in the 1870s protects against exactly that risk. And in Chapter 2, I'm going to show you how to build the modern version of this system using tools that didn't exist 140 years ago. Here's how you build the modern version of the three-account system that protected frontier wealth in the 1870s. The tools have changed, but the strategy is identical, and it'll protect you when the next financial crisis hits. Account 1 is your operating account. This is your checking account at your primary bank, the one you use for daily expenses, bills, and immediate cash needs. Keep 30 to 45 days of operating capital here and nothing more. Why the limit? Because the FDIC only insures deposits up to $250,000 per depositor per insured bank for each account ownership category. If you've got more than that sitting in one institution and the bank fails, you're at risk of losing everything above the insurance limit. Account 2 is your reserve account, and this is where most people screw up. You don't open this at the same bank as Account 1. You open it at a completely different FDIC-insured institution. This is your high-yield savings account that holds 3 to 6 months of emergency reserves. In 2025, high-yield savings accounts are paying between 4% and 5% APY, depending on the institution, significantly better than the 0.01% you'll get at a traditional brick-and-mortar bank. And because it's at a different bank, you've got separate FDIC coverage of $250,000. Think about what this does for you. If your primary bank collapses, like Silicon Valley Bank did in 2023, your operating account might be frozen for days or weeks while the FDIC sorts it out. But your reserve account at a different institution stays accessible. You can transfer money, pay bills, and keep operating while everyone else is panicking. Account 3 is your long-term savings and investment account. This doesn't sit in a bank at all. You move it into assets that can't vanish in a banking panic. Brokerage accounts holding stocks and bonds, real estate, precious metals, or treasury securities. Here's why that matters. The FDIC insures bank deposits, but it doesn't insure investments. Your brokerage account holding $500,000 in stocks isn't protected by FDIC insurance, but it's also not at risk if your bank fails. The assets are held in your name at the brokerage, not the bank's name. Brokerage accounts actually come with SIPC insurance, which covers up to $500,000 in total account value, including $250,000 in cash. Better protection than FDIC in many ways. And here's the part most people don't understand. Brokerage accounts often have stronger security than bank accounts. They use stricter access controls, more advanced transaction monitoring, and higher compliance standards than typical banks. Your assets sit in a separate layer of protection that keeps them insulated from the brokerage's own financial problems. Now let's talk about maximizing FDIC coverage within the system. Because there's a way to protect more than $250,000 at a single institution if you structure your accounts correctly. The FDIC calculates coverage by account ownership category, not just by total deposits. A single account in your name alone gets $250,000 of coverage. A joint account with your spouse gets another $250,000 per co-owner, meaning $500,000 total coverage on that joint account. But here's the catch. You still need geographic and institutional diversification. If your primary bank fails, all your accounts at that bank get frozen simultaneously, even if they're in different ownership categories. The FDIC will eventually make you whole up to the insured limits, but you might wait days or weeks to access that money. That's why you need Account 2 at a completely different institution. So here's the structure you're building. Account 1, operating capital at your primary bank, 30 to 45 days of expenses. Account 2, Emergency reserves at a different bank in a high-yield savings account. 3 to 6 months of living costs. Account 3. Long-term wealth in non-bank assets like brokerage accounts, real estate, or treasury securities. This is exactly what frontier businessmen did in the 1870s, just with modern tools. They kept operating cash at the local bank, reserves at a regional institution in a major city, and long-term wealth in hard assets that couldn't disappear in a panic. And it worked every single time. When the Panic of 1893 wiped out banks across the country, the men using this system survived with their fortunes intact. When Silicon Valley Bank collapsed in 2023, depositors with accounts at multiple institutions could still access their money while SVB customers waited for the FDIC to sort through the wreckage. If you're watching this and thinking about your own financial security, subscribe now. Because what I'm about to show you in Chapter 3 is the mistake that kills this strategy before most people ever implement it. The 3-account system only works if you actually fund all 3 accounts. And in 2025, most people get this part completely wrong. Here's the fatal mistake that kills the 3-account system before most people ever implement it. They try to fund all 3 accounts simultaneously and end up funding none of them properly. You can't build 3 financial 40ers at once when you're living paycheck to paycheck. Start with account 1, your operating account, because you already have this. It's your primary checking account where your paycheck lands and your bills get paid. The goal isn't to change what's there, it's to cap what goes there. Calculate your actual monthly expenses, rent, utilities, food, insurance, transportation, debt payments, everything. Multiply that number by 1.5 to give yourself a 50% buffer. That's your account 1 maximum. If you're spending $3,000 per month, cap account 1 at $4,500. Once your balance exceeds that amount, you start building account 2. Here's where frontier businessmen had an advantage we don't. In the 1870s, they got paid in cash and physically decided where every dollar went. In 2025, direct deposit dumps your entire paycheck into one account, and you have to manually move money around. Fix that problem by automating the funding sequence. Set up automatic transfers from account 1 to account 2 the day after your paycheck hits. Start with 10% of your gross income if that's all you can manage. If you're earning $5,000 per month, that's $500 moving automatically from account 1 to account 2. You never see it, you never touch it, and you can't spend it on things you don't need. This is your emergency fund, the 3 to 6 months of living expenses that frontier businessmen kept at regional banks in San Francisco or Denver. In 2025, it sits at a completely different FDIC-insured institution earning 4% to 5% interest. Don't touch this money unless you lose your job, face a medical emergency, or encounter a true crisis. Not for vacations, not for new furniture, not because you saw something you wanted to buy. Here's the timeline most people get wrong. They want account 2 fully funded immediately, so they try to save $15,000 in 3 months by cutting every expense to zero. That lasts about 6 weeks before they burn out and quit. Frontier businessmen took 18 to 24 months to build their reserve accounts. They saved consistently, not dramatically. They prioritized account 2 over account 3 because liquidity mattered more than long-term growth when bank panics could wipe out everything overnight. In 2025, that means funding account 2 completely before you move a single dollar into account 3. Emergency fund first, investment second. Cash reserves before brokerage accounts. Why? Because if you lose your job with $30,000 in a brokerage account, but zero emergency fund, you'll be forced to sell those investments at the worst possible time to cover rent and groceries. And if the market is down 20% when you need that money, you've just locked in losses you'll never recover. But if you've got 6 months of expenses sitting in account 2, you can ride out unemployment without touching account 3. Your investments stay invested, compounding through the crisis while your emergency fund keeps you alive. Here's the funding priority that works. Account 1 gets capped at 1.5 times monthly expenses. Everything above that cap flows automatically into Account 2 until you hit 6 months of reserves. Only after Account 2 is fully funded do you start building Account 3. And even then, you maintain the automatic transfer to Account 2 to replace any emergency funds you use. Think about what this does. If an emergency hits and you pull $5,000 from Account 2, your automatic transfer system rebuilds that $5,000 over the next few months without you making a single decision. The system runs itself. This is exactly how frontier businessmen operated. They established funding priorities and stuck to them religiously. Operating account first, reserve account second, hard assets third. The men who survived multiple banking panics between 1873 and 1907 didn't get fancy. They built boring, predictable, automated systems that protected their wealth when everyone else was panicking. Most people fail at the 3-account system because they overcomplicate it. They open 7 different accounts at 5 different institutions and lose track of where their money is. They split contributions across multiple goals and never fully fund any of them. Simplify the structure. 1 operating account. 1 emergency reserve account at a different institution. 1 long-term investment account once the first 2 are stable. Fund them sequentially, not simultaneously. Automate the process so discipline isn't required. And maintain the priority even after all 3 accounts are established. If you're watching this and you haven't started building Account 2 yet, subscribe now. Because Chapter 4 shows you the exact timeline frontier businessmen followed to fully fund all 3 accounts, and how you can compress that timeline using tools they never had access to. The 3-account system only works if you actually fund it, and the funding sequence matters more than most people realize. In the 1870s, frontier businessmen took 18 to 24 months to fully fund all 3 accounts: operating, reserve, and hard assets. In 2025, you can compress that timeline to 12 to 18 months if you're aggressive, but only if you follow the exact sequence they used. Here's the timeline that worked. Month 1 to Month 3. Cap Account 1 and establish the automatic transfer to Account 2. Don't try to save huge amounts yet. Focus on building the habit. If you can only move $200 per paycheck into Account 2, that's fine. The goal is establishing the system, not hitting a target number. Month 4 to Month 12. Increase the transfer amount to Account 2 every time you get a raise, bonus, or eliminate an expense. Got a $100 per month subscription you don't use? That $100 goes straight to the automatic transfer. Paid off a car loan that was costing you $350 per month? That entire $350 gets redirected to Account 2. Your lifestyle doesn't expand, your emergency fund does. Frontier businessmen called this living below your means, and it's the only way the 3-account system works long-term. When silver miners in Virginia City got raises, they didn't buy better horses or nicer hotel rooms. They banked the difference. By month 12, you should have 3 to 4 months of expenses saved in Account 2 if you're transferring 15% to 20% of your gross income consistently. By month 18, you hit 6 months of reserves. Once Account 2 reaches 6 months of living expenses, you stop increasing it and start building Account 3. But here's the critical part. You maintain the automatic transfer to Account 2 at a reduced level to replace anything you withdraw. If you were saving $800 per month to build Account 2, drop that to $200 per month for maintenance and redirect the other $600 to Account 3. That way, if you pull $2,400 from your emergency fund for car repairs, it rebuilds automatically over 12 months without you thinking about it. Account 3 is where you compress the timeline using modern tools frontier businessmen never had. In the 1870s, buying real estate or livestock took months of negotiation and physical travel. In 2025, you open a brokerage account in 10 minutes and start investing the same day. Start with low-cost index funds that track the S&P 500 or total market. Don't get fancy with individual stocks or complex strategies. Frontier businessmen bought simple, boring assets that held value across boom-bust cycles: land, livestock, precious metals. Modern equivalent is broad market index funds that own pieces of the entire economy. They survived the 2008 financial crisis, the 2020 pandemic crash, and every other downturn since their creation. The funding sequence for Account 3 follows the same automation principle as Account 2. Set up automatic transfers from Account 1 to your brokerage account the day after your paycheck hits. Start with whatever you were putting into Account 2 minus the maintenance amount. If you were saving $800 per month to build reserves, and you've dropped that to $200 for maintenance, you've got $600 per month flowing into Account 3 automatically. Over 12 months, that's $7,200 invested. Over 5 years, that's $36,000 plus compound returns. Here's where most people screw up the timeline. They try to fund Account 3 before Account 2 is complete. They see the stock market climbing and panic about missing gains, so they divert money from emergency savings into investments. Then they lose their job, have zero liquid reserves, and are forced to sell investments at a loss to pay rent. That's exactly what happened to prospectors in Virginia City who bought mining equipment on credit before they'd saved operating reserves. When the silver boom ended, they couldn't pay their debts and lost everything. The correct sequence never changes: operating account, emergency reserves, long-term investments. No shortcuts, no exceptions. Now let's talk about maintaining the system once all 3 accounts are funded. Frontier businessmen reviewed their accounts quarterly and rebalanced if one account grew too large relative to the others. In 2025, you do the same thing. Every 3 months, check your balances. If Account 1 has crept above 1.5 times monthly expenses, move the excess to Account 2 or 3. If Account 2 has grown beyond 6 months of reserves because your living expenses dropped, move the excess to Account 3. This quarterly rebalancing keeps the system running efficiently without constant micromanagement. Set a calendar reminder for the first week of January, April, July, and October. Spend 20 minutes reviewing balances and making adjustments. The 3-account system isn't static. It evolves as your income and expenses change. When you get a raise, increase the automatic transfers to Accounts 2 and 3 proportionally. When you have kids and expenses jump, recalculate your 6-month reserve target and adjust funding accordingly. Frontier businessmen who survived multiple banking panics between 1873 and 1907 treated the 3-account system as a living framework, not a one-time setup. They adjusted funding priorities based on economic conditions, personal circumstances, and risk exposure. But they never abandoned the core structure: 3 accounts, 3 purposes, 3 layers of protection. In Chapter 5, I'm going to show you the stress test Frontier businessmen used to verify their 3-account system would actually survive a banking panic, and how you run the same test in 2025 to ensure you're protected before the next crisis hits. The timeline matters, but verification matters more, because a poorly funded 3-account system is just as dangerous as having no system at all. Here's the stress test Frontier businessmen used to verify their 3-account system would actually survive a banking panic. And it's the same test you need to run in 2025 before the next crisis hits. They called it the 6-month shutdown scenario, and it revealed every weakness in their financial structure. The test was simple. Assume your primary income stops completely tomorrow. Can you survive 6 months without touching Account 3? If the answer is no, your system isn't ready. If you'd be forced to sell investments within 90 days to cover rent and groceries, you've built the accounts in the wrong order. Run the numbers right now. Add up your monthly expenses, every dollar that goes out the door each month. Multiply by 6. That's your survival number. Now check your Account 2 balance. If Account 2 contains less than your 6-month survival number, you're not protected. You've got a 3-account system in name only. The structure exists, but it won't save you when the crisis hits. Frontier businessmen who survived the panic of 1873 had their full 6 months funded before they moved a single dollar into hard assets. The men who skipped that step and bought mining equipment or real estate before building reserves lost everything when local banks collapsed. They were forced to sell assets at distressed prices to cover basic living expenses. In 2025, the mistake looks different, but the outcome is identical. People build brokerage accounts and investment portfolios before they've fully funded emergency reserves. Then they lose their job, panic, and sell stocks at a 20% loss to pay rent. Fix this problem before it happens. If your Account 2 balance is below 6 months of expenses, stop contributing to Account 3 immediately. Redirect every dollar back to Account 2 until you hit the full 6-month target. Here's the second part of the stress test. Assume your primary bank fails tomorrow and your Account 1 gets frozen for 30 days while the FDIC sorts it out. Can you access cash from Account 2 without penalty or delay? If Account 2 is at the same institution as Account 1, you fail the test. Both accounts get frozen simultaneously, and you've got zero liquidity for a month. This is exactly what happened during the panic of 1893. Depositors who kept operating funds and reserves at the same bank lost access to both accounts when that institution suspended operations. They couldn't pay rent, couldn't buy food, couldn't cover basic expenses. The frontier businessmen who survived had their reserve accounts at completely different institutions in different cities. When the local Virginia City Bank closed, their San Francisco reserves stayed accessible. They transferred money west to east and kept operating while everyone else panicked. In 2025, verify that Account 2 is at a completely different FDIC-insured institution than Account 1. Different bank, different website, different login. If one fails, the other stays operational. Third stress test. Assume the stock market drops 40% tomorrow and stays there for 18 months. Can you leave Account 3 untouched and let it recover? If you'd be forced to sell investments to cover emergencies during that 18-month period, your Accounts 1 and 2 aren't funded properly. You're using long-term investments as short-term emergency reserves, which is exactly backward. Account 3 should only contain money you won't need to touch for at least 5 years. If there's any chance you'll need that money in the next 24 months, it belongs in Account 2, not Account 3. Because forced liquidation during a market downturn locks in losses you'll never recover. Frontier businessmen understood this instinctively. Their hard assets, land, livestock, precious metals, were long-term stores of value. They never sold those assets to cover short-term expenses. They used operating cash and reserves for that. If you're watching this and your 3-account system passes all 3 stress tests, subscribe now, because you're in the top 5% of people who've actually built financial protection that works. But if you failed even one test, you've got work to do before the next crisis hits. Here's the maintenance schedule that keeps the system working long-term. Quarterly reviews. First week of January, April, July, and October. Check all 3 account balances. Verify Account 1 hasn't crept above 1.5 times monthly expenses. If it has, move the excess to Account 2 or 3. Confirm Account 2 still equals 6 months of current living expenses. If your expenses have increased, new mortgage, kids, higher insurance. Recalculate the target and increase funding. If expenses dropped, move the excess to Account 3. Review Account 3's asset allocation and rebalance if necessary. But don't panic sell during market downturns. That's when you should be buying more, not selling. Annual stress test. Run all 3 scenarios every January. 6-month income shutdown. Primary bank failure. 40% market drop. If you pass all three, your system is working. If you fail any test, adjust funding priorities immediately. Don't wait for the crisis to expose the weakness. The three-account system that protected frontier businessmen through 5 banking panics between 1873 and 1907 still works in 2025. But only if you fund it correctly, maintain it consistently, and stress-test it annually. Because the pattern hasn't changed in 150 years. Economic crises are predictable, bank failures happen, and the people who survive are the ones who built protection before they needed it.